Okay. Good morning, friends. Good morning, Ishan. Well, Sandeep, good morning. Sandeep says use both English as well as Hindi. Well, Sandeep, I would love to use Hindi. In fact, it is my mother tongue and I'm more comfortable with that. But then, English is the medium where you got to write your paper in English, and therefore it's better to learn everything in English. Good morning, Noor. Good morning, Priyakant. There's a query from Priyakant. He's asking, well, his query is in Hindi. I'll try and answer it in Hindi. Okay. Section 10, clause 6 deals with diplomats. The the subclause 2 deals with diplomat. Now, diplomats का क्या होता है ना? They are governed by Vienna Convention. Usually, countries don't tax diplomats. Diplomats are considered to be, representative of the other country, and the entire right to tax their salary lies with the country whom they represent. तो ऐसा जो क्वेरी है ना, ये प्रैक्टिकली पॉसिबल नहीं है. Usually there is no tax on the diplomats of the other country within our country as well. मतलब अगर कोई यूएस का डिप्लोमेट है जो इंडिया में लोकेटेड है, वेल उसकी सैलरी यूएस में ही टैक्सेबल होगी, इंडिया में नहीं होगी, दो ही इज लोकेटेड विद इन द कंट्री. ओके. गुड मॉर्निंग दीक्षा. गुड मॉर्निंग सुशील, भूमिका, कोमल. ग्रेट. A very happy morning, friends. And what we are doing today is the first head of income, salaries. You have already learned the concept of income. You saw the scope of total income. We saw those items of income, which are exempt from tax or which do not form part of the total income. And while you were discussing the scope, you came to a conclusion that all the items of income got to be segregated into 5 heads. There are broadly 5 heads of 5 Pandavas, and everything revolves around this 5 head. So if a particular item of income is not classified under any of the 5 head, well, it is very difficult to tax that particular income. See the head, why we need to classify in different heads. The reason is simple. Every head of income has got a different scheme. There is a charging provision. So all of you are aware about it. There is always a charging provision. You have already seen section 4, which was the parent charging provision, but each of the head of the income has got a separate charging provision. 2, there is a set scheme of deductions. So unless and until a deduction is allowed, you are unable to take it. So deductions are specified in different provisions of that particular head. And 3, there are PGBP, and when you get into house property income from other sources, you come to know about those specific items which are, disallowed, irrespective of whether they are revenue expenditure and they have been incurred for the purposes of earning the income, yet to be disallowed specifically. So the scheme depends on the head of the income. When it comes down to salary, salary is one such head where there are only 3 sections governing salary. So it might so seem that, it is very simple, only just 3 sections to learn. There is section 15, which is the charging provision. There is section 16, which gives you, there are only 2 important items which provide deduction. There are 3 total. Out of 3, 2 are widely used. And there is section 17, which defines salary. That's all. So you have got one charging provision, one provision giving deduction, and the third provision defining what is salary. And then, it's not that simple. It is, in fact, very complex because there are a lot of rules that govern salary. Two, there are a lot of exemptions. So while we were dealing with exemptions, we did not take into account those items of exemption which were governed under the head of salary, which were governing the head of salary. So that is something we'll discuss as the lecture progresses. But understand again, coming to the real world, salary happens to be one of the most important heads. See, department, in the income tax department came out with some statistics for the assessment year 18-19. In the year 2019, just prior to COVID, so we did not see statistics thereafter. Therefore, I'm quoting those statistics which were released in 2019. And there were roughly 5.87 crores Indians who were filing their returns with the department, individuals. And out of that 5.87 crore, friends, 2.80 crore, no, almost 2.80, 2.90 crore people were salaried employee. So, and therefore, 50% of the total filers are using this head of income. They are declaring income under this head. So they are salaried employees. So you could safely assume that of the total tax collection out from the individual, 50% of it would come from the salaried individual, or probably more than that. And even though there are only 3 sections, but because of the rules and the valuation rules as far as the perquisite is concerned, it becomes extremely complex. In fact, there is nothing simple as far as the Income Tax Act is concerned most of the time. And therefore, you have to revise the provisions again and again so as to, have a grip on this particular head. And I feel that this particular head is important also because, as you get into finals, there would not be too much of a testing as far as salary head is concerned, because in finals there are different, you've got a lot of other things to test a student. But when it comes down to intermediate, well, salary remains a very important head. Now, who could be taxed under this particular head? An assessee who's in receipt of salary, very, very simple. Every assessee who's getting salary. Now, when can a person be said to have received salary, or who would receive salary? Only if an assessee is an employee of an employer. Would he receive salaries, and would he be taxable under this particular head? So one of the foremost thing is that there should be an employer and employee relationship. Without an employer-employee relationship, well, there could be no salary and nothing would be taxed under this head. So if at all there is not an employer and employee relationship, and if you receive some amount, well, one thing for sure, it is not going to get under this head. Let's first read the charging provision, which is under section 15. Charging provision on your screen, it says the following income shall be chargeable to income tax under the head of salaries. So what is that income? Any salary. Now, what is salary? Therefore, salary would be, defined under section 17. What is salary? Salary is something defined under section 17. Now, how it is defined, we'll come to it in a short while, but understand what is chargeable under this head. Any salary due from an employer or a former employer to an assessee in the previous year. So whatever is due from an employer by the assessee, and it constitutes salary, would be taxable under this head. Simple. Now, what do you understand by the term due? Salary becoming due. So whether it is akin to salary accruing, the answer is no. See, accrual happens every minute, every hour, every day. So accrual is a continuous process. Whereas due, it would become due on a particular date, at a particular time. So usually when it comes down to salary, either it becomes due on the last day of the month or the first day of the subsequent month. Are you getting my point? So salary would be either due on the last day of the month or the first day of the subsequent month, depending on the policy of the employer. And we're not talking of an accrual system. So let's say if the salary is becoming due on 15th of the next month, well, in that case, you're not to accrue 15 days of salary and make it taxable. It would be taxed on due basis. Second, the point B takes into consideration any salary paid or allowed to him in the previous year by or on behalf of the employer or a former employer. We are also talking of former employer. So it is not just the current employer, but it is also the amount received from former employer. Usually, salaried employees retire, and if they retire, they do get some amount of money from the former employer as a support. Usually, we call it as pension. So, if at all a person is in receipt of pension from a former employer, although there is no existing employer-employee relationship, yet the pension would be taxed under this head, and therefore you've got salary becoming due from employer or former employer, or any salary paid or allowed to him during the previous year by the employer or the former employer. Now, therefore, here salary is either taxed on due or received basis, whichever is earlier. So if it becomes due and not paid, yet it would be taxed in the previous year. If it does not become due, but it has been paid for, yet it would be taxed in the previous year in which it is paid for. Are you getting my point, friends? Yes, simple. So salary is always taxable on due or received basis, whichever is earlier. Similarly, there is one area wherein what happens is at times employees also get arrears of salary. Now, what are these arrears? Arrears are that part of salary which you get a hike or an increment with a retrospective effect. So you are getting a hike in the year 2022, which gives you a hike with effect from, let's say, 2019. In that case, you'll get the entire amount in 2022, in respect of the previous year, in respect to the preceding previous year. Now, these arrears are to be taxed in the year in which they are paid for, or when it becomes, certain that you are going to receive those arrears. Usually the government employees do get hikes. You would have heard about pay commission. There are pay commissions which are set up by the government. So last pay commission in India was the 7th pay commission, which was established in 2013, and they gave recommendation. It takes considerable time to evaluate what is the amount of hike to be given to the employee, and therefore considerable period passes. Now the hike is given with a retrospective effect. We do give hike, from the date on which the pay commission was established, although it was decided in the year 2015 or 2016 that hike should be given. That hike is given with a retrospective effect from 2013. Now what happens? The amount is received in the year 2015 or 2016. Until then, you're not aware what is the hike you're going to receive. So there could be, it is very difficult to tax the arrears unless and until it is certain that you'll receive it. Therefore, you have got the enabling provision which says that any arrears of salary would be taxed in the previous year when it is paid or allowed, whenever that salary is paid or allowed to the employee. Are you getting this, friends? Whenever it is paid or allowed to the employee, it would be taxed in that previous year. Now, once an item of salary is taxed on due basis, well, we don't tax it again on receipt basis. Simple. There could be no double taxation of the same item of income. Similarly, if at all a particular item of salary is taxed on paid basis or receipt basis, it is not again going to be taxed on due basis. Then remember one thing though, any salary, bonus, commission received by a partner. Now partner receiving salary would not be taxed under this head, because partners per se, there is no employer-employee relationship between partner and a partnership firm, and therefore it is taxed it is specifically taxed under section 28. Under section 28V of the Act, it is clarified under this charging provision as well, that salary given to a partner would not be taxable under this head. Let's take up a problem. I'll just share with you a very simple example wherein you'll understand the meaning of due or receipt basis in case of salary. Just read this. Okay. Is the question visible? So here we've got Miss Riddhi, who's a doctor, who furnishes the following information for working out gross salary. We are concerned with gross salary prior to deduction and exemption. Let's check it out. She was employed in a government hospital. They say, the problem says that she was employed in a government hospital with a fixed salary of rupees 1 lakh per month, due on the first day of next month. So whenever she got the salary, so March salary for the March would have been paid in the month of would become due in the month of April. So April 22, 1st of April 22, she will get salary for the month of March, which becomes due in the month of April. Right. Similarly, if she's working in a government hospital, continues to work in the government hospital, March 2023 would become due in April 2023. Right. However, on 1st July, she joins private hospital at a salary of rupees 2 lakh per month, due on the last day of each of the month. Salary would become due on the, let's say if it is the month of April, in this case it is the month of July, let's say it is the month of July, her salary for July would become due on 31st of July itself. Right. So she is getting 2 lakh rupees from the month of July. So until April, May and June, she's getting 1 lakh rupees, and in respect of salary for the month from July onwards, she'll get 2 lakh rupees. Now, government hospital pays her arrears for the month of July 19 to March 20. So she's got arrears of salary of rupees 3 lakhs on 1st November 22. Now understand, with respect to arrears, she would not never know that she's going to get those arrears unless and until it is declared by the government hospital that they are going to pay it. Now, once it is paid for, it becomes certain that it has to be taxed in the previous year in which it is actually paid for. Now, she draws salary of April 23 and May 23 in advance. So she's drawing advance salary. Now, understand, advance salary is going to be taxed in the year of receipt, though it has not become due. Now, April and May has not become due during the up to 31st of March 23, but yet it would be taxed in the year of receipt. Well, there is a very simple walk around in order to escape taxation on receipt basis. What she could do is she could take an advance against salary. So advance against salary is kind of loan taken from the employer, and to be adjusted whenever the salary becomes due. So instead of taking advance salary, she could take advance against salary. So loan against salary. Then it doesn't, it is not salary that is received, but a loan that is received from the employer. The effect is all the same. So a loophole there. Now, due to crisis in the month of March 23, the salary for February and March 23 could not be paid to Riddhi. Right? So salary was not paid for the month of February and March, though it becomes due. Now, could you work out the amount of salary that is going to be taxed? Can you give me a number? So I'll give you 30 seconds. Anybody? Just give it a try. Okay, Harshita says it's 26 lakhs. Okay, I've got a few answers. Harnoor says it's 30 lakhs. Darshan says it's 25 lakhs. Let me show you the solution. Let us just check it out. I hope the solution is visible as well. It is visible. Okay. Let's first look at the first part of the story. See, she was employed with government hospital. I already told you that the salary for the month of March 22 would become taxable in the current previous year. Why it would become taxable? Because it is becoming due on 1st of April. The government hospital salary is due on the first day of the next month. So March 22 is due on 1st of uh, April 2022. Let's say it's received on 7th of April 2022. So it's going to be taxed on due basis. Then from April 22 till June 22, she continues to work in the government hospital only. See, she is going to work in government hospital until 1st July 2022. And therefore, salary would become due on the first day of the next month. April, salary of April would become due on 1st of May. May would become due on 1st of June. However, there is a shift from July 22. From July 22, she is going to receive, the salary would be received on 7th of the next month. However, it becomes due on 31st of July itself. So it is becoming due on the last day of the month. And the salary has also increased. So as far as the government hospital is concerned, are you clear that 4 months salary is going to be taxed in case of government hospital during the current previous year? That is previous year 22-23 on due basis, right? From July onwards until the month of January, from July to January 23, she's working with the private employer and there is absolutely no problem. However, for the month of February and March, what happens is for the month of February and March, the salary has become due, but it has not been paid. Now, even though it has not been paid, since it has become due, we are going to tax it on due basis. Further, in the month of for the month of April and May 23, what happens is the salary is taken as advance. April and May 2023, though it has not become due and it would become due on 30th of April 23. The salary for the month of April would become due on 30th of April 23, and I would take that salary. That salary would become due on that last date. However, I have already taken the salary in advance on 15th of November 22, and therefore it is going to be taxed on receipt basis, right? And I have also received arrears of salary. Look at this. I've got arrears during the current year pertaining to July 19 to March 20 on 1st of November 22. So 3 lakh rupees to be taxed on due and receipt basis, right? And therefore the total salary, yes, it is indeed 29 lakhs. 29 lakh rupees is going to be taxable in the hands of Riddhi. the gross salary on due or receipt basis, whichever it is earlier. Well, yes, you're right, Vaishali. Fantastic, 29 lakhs. You would have made some error here or there with the answer. You just have to, just reconsider that the information given to you is, if you take that information into account step by step, well, you'll get the right answer. All right, let's move further. I hope you got this. Now, now there's a question from Harshita. What if the arrears, I always knew that the arrears are going to come to me and I tax it in the financial year 1920 itself. If I tax it in the financial year 1920 for any reason, it is not going to be taxed again. Once salary is paid either on advance basis or on due basis, then it is not going to be taxed in any other subsequent year. Noor, something like this is not going to come into the exam. When it comes down to presentation, you'll have to check out for a full-blown problem. This was a very small problem that I had given you only to test your concept. Arrears usually do not become due earlier. Arrears is a process wherein the management and the employees are fighting for a hike. So usually it is only at the end of the fight that they would receive arrears. So usually there are never an arrears which are due earlier. What could happen is there could be liability of the employer to pay the employee. He's not paying salaries to the employee. That could happen. Non-payment of salary is different from arrears. Kiran, if you be specific, I'll try and explain what you did not get. Or you just, go through the lecture once again. But it is simple. Salary is taxable on due or receipt basis, whichever is earlier. Now, employer and employee relationship, we cannot overemphasize its value unless and until there is a employer-employee relationship. Nothing could be taxed under the head of salary. Now, if at all a particular person is an agent, look here, what we are talking of. An employee works under a direct supervision control. So there are three aspects. There is a direct supervision of the employer. There is control of the employer. 2 and 3, he works as per the instruction of the employer. Now, when you look at the agent and a principal relationship, you'll find that it is almost the same. Agent and principal relationship, agent would work at the instruction of the employer. There would be, most of the time the principal would supervise the work of the agent. However, the control is missing. When it comes down to the principal agent relationship, there is no control over the agent. There is no direct control. He cannot and usually there is lesser of supervision also. Agent is independent in a way. However, employee isn't, right? The capacity in which payments are received would determine the taxability. So if at all there is some payment received from the employer to the employee, but not in the capacity of the employer-employee relationship, that would again not be taxable in this case, under this head. Let me just show you a few examples. Let's go with a story. Pariniti has got a triple honors degree in business, finance, and economics. She joins Yashraj as a public relation officer, and she's getting salary of 1 lakh rupees per month. Now she's a public relation officer. Yashraj is going to be the employer. Whatever she receives is in the nature of salary. None therefore taxable under this head. Now what happens is, while she is working with Yashraj as a public relation officer, she also does a bit of freelance acting. She is also working as a freelancer and does some acting and gets 50,000 in addition to salary. Now, this 50,000 of freelance acting, which she has done, is not in the capacity of the employee of that organization. And therefore, whatever she receives out of such a relationship where it is not employer and employee relationship, that case it would either fall under the head of profits and gains of business or profession or income from other sources. Moving further, if at all, Pariniti then lands into a lead character in movie and she's paid 2 lakh rupees per month as employee. So earlier she was being paid 1 lakh rupees per month. Now, since she's not just the PR officer, but she's also a lead character in a movie, she gets 2 lakh rupees per month in a movie and 1% commission of the total collection of that movie. Now, do you think there is an employer-employee relationship over here? In this case, do you think there is an employer-employee relationship? Well, I've got a few yes and few no. Well, she's a lead character, but she's also employed with Yash Raj. And Yash Raj is paying a fixed sum of 2 lakh rupees per annum. She's under direct control supervision of the Yash Raj films over here. She's not entitled to work with any other employer. She's going to get a fixed sum and also 1% commission on the collection. Now, this commission on collection, I've just taken this component specifically because this is very important. There's a landmark ruling in case of Gestetna duplicators. I'll discuss that landmark ruling in a short while, but understand this commission is received by Pariniti by virtue of her employment with Yashraj. Had she not been employed, she would not have got this 1% commission on collection. And therefore, this is found to be incidental to the employer-employee relationship and forms part of the salary. Yes. Here, since there is an employer-employee relationship, it would still continue to be taxed as salary. However, when this happens, subsequently, case 4, Pariniti is now working in multiple movies with different movie houses. So she's working with Yash Raj or Dharma Production or UTV or any, Red Chilies, etc., etc. And she's charging 2 crore per movie. Now here she's working as a professional. She is independent to choose the movie. She's independent to work with any of the production houses. And therefore, this particular amount is not going to be taxed as income from salaries. Definitely not as income from salaries. And looking at the organized activity, well, it would be taxed as PGBP. Yes, are you getting it, friends? Okay. Let us go ahead. So it's all about, supervision, control and the instruction of the employer. And see, remember, any remuneration received from either the former employer, present employer, or a future employer, everything would be taxed under this head. There should be an employer-employee relationship. That's all. Multiple employers, a person working part-time in one of the organization and the other part is working in another organization. Especially, with the work from home culture, a lot of people are working for multiple employers, and it's a big headache for the HR to figure out who's working with with multiple employers. If you are also working with multiple employers, all the employees taken together would become your salary income. Going further, foregoing of salary. See what happens. A person is in receipt of salary, but then because of some problems with the organization, he forgoes his salary. You would have heard about a lot of CEOs, they charge 1 rupee. In difficult times, they'll not take their remuneration, they'll forgo the remuneration. Now, if it is so foregone, after it becomes due, if the salary becomes due and then you forego it, well, it is going to be taxed in your hands. If you forego it prior to that salary become due, well, then it would not be taxed in your hands. But then foregoing means something that you have already earned. If you have not earned it, in that case, you cannot forego it. So foregoing is always after salary becoming due. Now, if it is so become due and you forego it, it is treated as application of your money. So if you have applied your income, well, it is going to be taxed in your hands. The foregoing of salary to be taxed, even though it is not received, since it has become due, it would be taxed in your hand. Similarly, but then, there is one exception, and that exception is surrender of salary. If you surrender the salary voluntarily, it has become due, but you surrender it in favor of the central government. So if you're giving it to the government, right, there is some disaster that has happened, and therefore what you do is your salary, you forego it in favor of the government for a complete month. Now, that is going to be, that is not going to be taxed in your hand if it is so surrendered in favor of the central government. Let's take up an MCQ on the employer-employee relationship. Well, okay, here we go. See, whose income is taxable under the head of salary despite no employer-employee relationship? Darshan is asking dividend received from shares. Well, it would be taxed under income from other sources. Okay. Well, I've started getting a few answers. Sudhanshu says it's C. C, professor of a college receiving remuneration from university. Certainly not. See, professor is employed with the college. The college is the employer. Now, college is usually, distinct from the university. If it is so, there's no employer-employee relationship between the professor of a college and the university. Whatever you get from university is not in the capacity of employee, but as a consultant probably, or as a paper checker, that is going to be taxed as income from other sources and not salaries. So C is certainly the wrong answer. Then coming to the member of parliament, Bhumika says it's a member of parliament. There can't be an employer and an employee relationship between member of parliament. Who's the employer in their case? Who would be the employer? It is we the people who choose them, right? So there could be no employer for a member of parliament, although they receive honorarium, but that honorarium is not in the capacity of an employee. And therefore, there is a old circular of the CBDT of the 1960s, which said that this honorarium of a member of parliament is going to be taxed under income from other sources. B is certainly not the answer. B, we have already seen it is going to be, any remuneration or interest or honorarium by whatever name called, in case of a partner from the firm is not in the capacity of an employer and employee relationship, and it is specifically made taxable under section 28V. If you remember, we've talked of it just now. 28B, it is going to be taxed, and therefore that leaves me with D. Now, in case of D also, there is no employer for a High Court or a Supreme Court judge because they are supposed to be independent. However, yet there is a ruling which says that it is going to be taxed as income from salary. It is a Supreme Court ruling which says that um, even if there is no specific employer for uh, for a High Court or a Supreme Court judge, yet it is going to be taxed as salary under Section 15. So Justice Devkinandan Agrawal 1999 Supreme Court judgment, which says that it is going to be taxed under this head. Moving further, so D is the right answer. Okay. In which of the following cases employer and employee relationship exist and therefore income is taxable under the head of salaries? Well, Harnoor is asking whether a CA is treated as an employee. Well, yes, a CA could be employee, but a practicing CA is not an employee for a client. There are two ways of employment. One is the employer and the employee relationship, and the other is as a consultant for a client. So if there is a client consultant relationship, in that case, the amount received from the client is not going to be treated as salary. Okay, Ishan says salary for February 22 would be due on March 22. So would it be taxed in the year 21-22? Yes, certainly, yes. Yes, Ishan. I guess you're referring to the first question that we dealt with. So if at all, salary of February 22 becomes due in the month of March 22, it would be taxed in the preceding previous year. Okay, I have already got a lot of A's for this question. And yes, indeed, Kiran, you're right. It is A. The option A is the right answer. See, B and C are out of question. We have already dealt with B and C. As far as option D is concerned, director of a company receiving commission for guarantee of loan. Now the commission is received for providing guarantee for a loan, and there is no employer and employee relationship between director and the company unless and until a particular director is also an employee director. So if at all a particular director is managing director of the company, he is an employee director and his remuneration would be taxable, but not a director simpliciter. And here, certainly there is no employer and employee relationship. It is a remuneration or it is a compensation given by the company for guaranteeing loan. And therefore, we are left with A. Now, official liquidators are appointed by court. They are officers of the court who liquidate all the assets and pay off all the liabilities of the company in case if the company is in liquidation. Therefore, official liquidator is the remuneration of official liquidator is going to be taxed under the head of salaries. I hope you understand, Noor, what is official liquidator after our discussion. Now, moving further, place of service. See, the golden rule of salary is that it is deemed to accrue or arise at a place where the services are rendered. Now, let's take up an example. See what happens. Mr. A was working in the country. He was a professor in one of the university. He was earning 3 lakh rupees of monthly salary. He retired during the year, and now he is in receipt of pension amount of rupees 50,000 per month. However, he shifted himself. He got shifted to the US. He has his son working in the US. He shifted to US. Now he's in receipt of 50,000 rupees while he's staying in the US. The pension is paid to him in his US account. Now, whether this pension would be taxed in India or in the US, well, the answer is it would be taxed in India, because this pension has arose by virtue of his employment within the country, within India, right? Services were rendered in India, and therefore the pension is taxable in India. I hope you're getting it. Section 9 deals with, the taxation of salaries. So what it says, I just give you a brief snapshot of section 9. Income which falls under the head of salary, if it is earned in India, it is deemed to accrue or arise within the country, provided the services are rendered in India or the rest of the leave period forming part of the service contract is, has been done here in India. So if it is leave encashment, something called as the leave encashment, I'll deal with this concept of leave encashment. But if the leaves were availed in India or the leaves were unutilized within the country, then it is deemed to accrue or arise within India, right? Similarly, salary paid by government to citizen of India outside India, that is deemed to accrue or arise within the country. Specific provision. This is something that I started with. Section 10(6) deals with diplomats. Diplomats of foreign countries, they are not taxable in India. Similarly, salary paid by government of India to an employee outside. So, assuming, let's say, there is a diplomat representing India, his salary would be paid by government of India. That is deemed to be accrued or arising within the country. Yes. Now, moving further, so I hope you're getting it. Advisor director remuneration. Well, no, Vaishali is asking whether an advisor director, his remuneration would be taxed under this head. The answer is no. Sitting fees is usually paid to directors who come for meeting. Now, if that sitting fee is paid, it is not going to be taxed here unless and until the director is employee of the company. Nothing is going to be taxed under this head. Moving further. So we now know the charge of salary. Charge of salary is where the remuneration is flowing from the employer to the employee on due or receipt basis. Now it is important to understand what constitutes salary. Now salary is defined under section 17(1). 17 subsection 1 defines salary to include. So it's an inclusive definition. Understand, it does not mean it includes. So when it is an inclusive definition, salary includes 1, 2, 3, 4, 5 and everything or anything alike. Right? It does not mean here it includes one. So you'll see that this definition does not cover a lot of aspects of salary, but yet that amount would continue to be taxed under the head of salaries. We'll discuss it first, and then I'll tell you which components are not covered. So, like salary includes wages. So salary would be inclusive of wages. Wages and salary, there is ideally no difference. Can you tell me what is the difference between wage and salary? Can you tell me what is the difference between wage and salary? Ishan, I'll come to your query in a short while. First, let's discuss this. I've got your query. I'll just answer it in a short while. Let's continue with the flow. All right. Yes. A lot of you have got the answer. Wages are usually given for manual work, and salary is given for mechanical or non-manual work. So wages usually given to workers on a day-to-day basis, or it could also be paid on a monthly basis, but for the manual work they do. So that's the only difference. But otherwise, wages for all practical purposes nothing but salary. Now, so it includes wages to annuity and pension. Annuity and pension. Annuities are annual payments. Annuity is what annual payment, isn't it? Anything that is paid periodically is pension. to an employee after the retirement. It is pension. So you understand both annuity as well as pension. So pension, we have seen one provision the other day, section 10 into bracket 19. It dealt with, exemption for pension, exemption in respect of pensions arising to gallantry award winners or those members of the armed forces who have suffered disability. Their pension is going to be exempted under section 1019. So it's important, like when you are reading the law, you correlate, make those cross connection. You'll remember the provisions very accurately if you make those cross connections. So whenever pension comes to my mind, I'll check, do I have an exemption? And yes, there is indeed an exemption under section 1019. So you are revising both the provisions together. Annuity is annual payment to be taxed as salary. Now, both annuity and pension should flow from the employer. Only if it flows from the employer for in lieu of your employment, then it would be taxable under this head. Then any gratuity. Now, what is gratuity? Gratuity is something that is paid gratuitously by the employer to the employee. As a matter of gratitude, because an employee has worked for a considerable long period of time. He has given his services for years together. And as a token of gratitude, the employer is going to pay to the employee a lump sum amount. Now, somehow, gratuity is usually paid, for meritorious service at the end of the retirement period. Now, after the retirement, at the end of the employment period, sorry, at the end of the employment period, on retirement, gratuity is paid. And now it is also statutory liability for the employer. So it is governed by the Payment of Gratuities Act of 1972. In most of the cases, the employer is liable to pay, right? Even if the employer is not liable to pay, he may voluntarily pay, because a particular employee has got a long service, he would pay some amount as a token of gratitude. That amount flows from employer to the employee at the time of retirement. So, post-retirement sometimes. So there is indeed no employer and employee relationship. And yet it would be taxable. See, understand, friends, there is a tree analogy. I'll explain you the tree analogy. See, there is a tree. And this tree has got fruits, right? Oh, well, I'm very bad at drawing. Please ignore. But then, these fruits are nothing but my revenue receipts. Because they are recurring, isn't it? They are recurring and they come out of the labor. You will water the plant, and as a result of that, you'll fertilize, water, and as a result of that, you'll get these fruits, and these fruits are going to be your revenue receipt. Without a doubt, this revenue receipt is always taxable. However, what happens if, what I do is I cut off this tree, I just sever the tree and sell the entire tree. Now, when I sell the entire tree, this becomes capital receipt. Now, usually this isn't taxable. Capital receipts under the Act are not taxable unless and until there is a specific provision. When it comes down to gratuity, this is a capital receipt. Because this is at the end of the employment, you have given away your salary, isn't it? These fruits or the salary, which was your recurrent income, source of income, you're not going to get that income. So similar to apples, once the tree is severed, once the tree is cut off, you're not going to get any more apples out of the tree. So you leave the employment, and the amount that you get after leaving of the employment is going to be your capital receipt. And therefore, to make it more reasonable, they've granted an exemption under section 1010 for this gratuity, which is a capital receipt. So it is a lump sum payment, but yet it is made taxable and exempt subject to a few conditions. So it is a conditional exemption that is granted. It is not that capital receipt would not be taxable. Capital receipt is taxable if there is a specific provision. And, in case of gratuity, you have got section 1010, which exempts part of it. Then going further, so I hope you understand the tree analogy. We'll time to time refer to this. Then any fees, commission, perquisite, or profit in lieu of or in addition to any salary or wages. So look at this. Fees, if at all, college has got a professor. Now that professor is an employee and the college pays paper checking fees to the employee. Now that fees would also become part of the salary. However, university is different. University paying to the professor who is employed with the college. There is no employer-employee relationship. That fees would become part of income from other sources. But college paying fees, it becomes salary. Commission paid to employees. Usually there is a performance-based commission, especially those people who are into sales. They do get a lot of commission based on the amount of turnover they achieve. So that commission is also part of the salary. Similarly, perquisites are in-kind benefit to an employee, right? So employee may not get cash always. At times you will get a car, right? In-kind benefit. So you'll get a holiday, in-kind benefit. So that is also taxable as salary. Similarly, profit in lieu. Profit in lieu means what? Profit, you don't get salary, but instead of salary, you get some profit. Now, these profit are usually in the nature of allowances, cash allowances, or retirement benefits. We are discussing this in a short while, but then understand profit in lieu or in addition to salary would also be part of the salary. Similarly, any payment for any period of leave not availed. Sometimes what happens is, the employees get a fixed amount of leave. Let's say 50 days in a year, they would get paid leave. But, an employee may be more efficient and he would not want to take any leave. So he doesn't avail those 50 days of leave. Instead of that, what he says to the employer, you pay me extra for those 50 days. You were giving me leave for 50 days. Now, instead of that, what you do is you pay me extra in lieu of those 50 days of unavailed leave. Now that leave encashment done by the employee is going to be taxable as salaries. See, any leave encashment that happens during the course of employment is going to be taxed. However, on retirement, if there is a leave encashment, there is a lump sum that is received by the employee, there is an exemption given. Right? Are you getting my point, friends? So we'll discuss leave encashment, exemption at the time of retirement. Moving further, but understand leave encashed is also part of the salary. Then we have got 0.6, 7, and 8, VI, VII, and VIII. It deals with annual accretion to recognized provident fund, annual accretion or transfer of amount from unrecognized provident fund to recognized provident fund, and employer's contribution to National Pension Scheme, NPS. These three items are also part of salary. Now, why these three have been specifically included? What happens? Employer do maintain fund for the benefit, for the welfare of the employees. There is fund created for the welfare of employees. Now, contribution is made by the employer into the fund. Contribution is also made by the employee into the fund. And the fund is utilized, at the time of retirement on superannuation or at the time of, termination of the employment. Now, this money contributed by the employer into the fund is neither received by the employee nor is it due. Actually, it doesn't become even due, because an employee would not get benefit of the money which is deposited into the fund until and unless, he withdraws that amount. But then specifically, they say that the annual accretion to RPF, which is chargeable to tax under Rule 6 of Part A of the fourth schedule, is going to be part of the salary. Now, when it would be deemed to be received, let me tell you when it would be deemed to be received. There is one Section 7 of the Act which deals with income deemed to be received. And it says that annual accretion to Provident Fund to the extent of amount in excess of 12% of the salary. So when an employer contributes more than 12% of the salary. So let's say a salary of a person is 1 lakh and the employer is contributing 15,000 to the Provident Fund. 3,000 rupees. 12% is 12,000 of 1 lakh. He is contributing 15,000. 3,000 would be deemed to be received by the employee. So even though it is not due, even though it is not received, yet it is deemed to be received by the employee and would be taxed as salary. Similarly, if at all the interest credited to that provident fund exceeds 9.5% of the rate, in that case also it would be taxable as salary. So interest taxable as salary. Understand this. This is quite unique. Interest otherwise would always find a way in income from other sources. But then here, interest is taxable as salary. On the employer's part of the contribution, whatever interest you earn out of over and above 9.5% would be taxable as salary. We'll take an example on this and then you'll understand this better. But then transfer of unrecognized provident fund to recognized provident fund. Whenever what happens is sometimes the provident fund got to be recognized by the commissioner of income tax, or it should be a statutory provident fund. Usually, you would have heard about employees provident fund, EPF. Now that is a statutory provident fund. However, if at all it is not recognized, then what happens? Then at the time of contribution, no salary is deemed to accrue. But then at the time of withdrawal, everything is taxed. We'll discuss this in detail again, but then understand, amount that is contributed by the employer to an unrecognized provident fund is not taxable in the year of contribution. It is taxable in the year of withdrawal. Now what happens? An employee moves from an unrecognized provident fund to recognized provident fund. It is deemed to be withdrawal and therefore it is deemed to have been received. Further, employer's contribution to pension fund or the NPS, well, that is going to be taxed as salary. National pension scheme is a new kind of a shift of the old, you would have heard about old pension scheme. If you follow a bit of politics, there is a lot of UN cry that the old pension scheme should be put in place. However, what it would lead to a lot of outlay, and therefore governments are reluctant to deploy the old pension scheme. Now you have got the national pension scheme, wherein what the government does, government contributes 14% of the salary of an employee, and the employee also makes an equal contribution. And thereafter, the pension scheme would pay the pension to the employee and not the government itself. So employer's contribution to national pension scheme, taxable. URPF, RPF, I'm going to take in detail. Don't not worry about it. I've just taken the meaning of salary and why the amounts are taxable under the head of salary. That was the entire contention. Was here, even if you have understood what salary means, it is fine. As far as RPF and URPF is concerned, do not worry. We are going to discuss in detail with example. Now, so friends, now if you read this inclusive definition of salary, you will realize that there is no bonus. Whatever bonus is paid to an employee, just because that salary definition doesn't have bonus, it does not mean that bonus is not going to be taxed as salary. That is what I meant when I said that salary is defined inclusively. So even if it is defined inclusively, still, that bonus would form part of salary. Right? Are you getting it, friends? Now, moving further, profit in lieu. Let's look at profit in lieu of salary. What is profit in lieu of salary? Profit in lieu of salary is specifically defined under section 17, subsection 3 of the Act. And again, it is an inclusive definition. You have got an inclusive definition to profit in lieu of salary. What it says, any compensation due or received by an assessee. So compensation, again the tree analogy. Remember the tree analogy. You have received compensation from employer or former employer. So employer or former employer. For termination, so you have terminated. It is as good as cutting of the tree. After your termination, you're not going to get the salary. So for termination or modification of the terms of employment, any compensation that you receive is going to be taxed as profit in lieu of salary. See, compensation post termination. Once you terminate, there is no employer and employee relationship. Any compensation received thereafter ideally should not be salary. But then, that compensation has accrued to you only because you were employed with the employer. And therefore, this compensation is specifically covered under section 17(3), and it is included, as profit in lieu of salary. Although, as far as termination of an employee is concerned, we've got a provision under section 10(10)(b), which deals with retrenchment compensation. So if at all a particular employee is removed from the company, forcefully asked to leave, in that case, he'll get some retrenchment compensation under the Industrial Disputes Act. And that compensation is going to be, though it is taxable under section 17(3), but would undergo exemption under 10(10)(b), subject to fulfillment of condition. Similarly, there is something called as voluntary retirement. So most of the time termination happens out of voluntary retirement of an employee. An employee would have worked for a longer period of time, and therefore he doesn't intend to work any further. He would voluntarily retire, and that is also exempt under section 10(10)(c), subject to certain limits, right? So compensation received on termination, though capital receipt, specifically made taxable. Then further, any payment due or received by an assessee from an employer or a former employer. So even if it is a former employer, still it is covered. From provident fund, as far as employer's contribution is concerned, that would be profit in lieu of salary, subject to obviously, exemptions which are provided. We'll discuss the exemption. I have already, told you that 10(10)(b) gives you exemption in respect of retrenchment compensation. So even if it is profit in lieu, yet it would be specifically exempted. Going further, so there are a few exemptions that you get under section 10(10). You get an exemption for gratuity. 10(10)(a), it is commuted pension, retrenchment compensation, VRS, payment from statutory provident fund, etc., etc. Right? So you've got a lot of exemptions. Moving further, item 3. Item 3 deals with a peculiar item of income. Let's see this. Any amount due or received, whether in lump sum or otherwise, by an assessee. Any amount due or received, whether in lump sum or otherwise, so it could be periodical or lump sum payment, by an assessee from any person before joining. Even amount received before joining of an employment. Now you would tell me, why on earth would anybody, pay amount before joining? We've not even joined the employment, but before joining the employment, well, I have got some compensation or amount that is received from a prospective employer. So here there is not even an employer-employee relationship, but there is, he's going to become my prospective employer. And this is something, of a recent origin, wherein employers have been giving sign-on bonuses. So you are leaving, let's say there is a stiff competition between two employers, Google and let's say Microsoft. Microsoft wants some of the employee from Google, And therefore, what it does is it gives a sign-on bonus. You leave Google, come to us, and we are going to give you 10 lakh rupees as a sign-on bonus. Now, this amount is accrued before joining of the employment, but yet it is taxable as profit in lieu of salary. Similarly, amount received after cessation of employment, yes, because it is by virtue of employment, it is entirely taxable as profit in lieu of salary, right? So this is all about the meaning of salary. We'll take a short break and then we'll start with taxability of allowances. So let's take a short break of 5 minutes, come back again. Good. Okay. Welcome back, friends. I'll just take up a few queries. Okay, Ishan. Ishan, to answer your query, why Pariniti was not charged under this head, but under other head of income when she was working with multiple production houses? The reason is because none of the production house had control over her, exclusive control over her, or none of the production house could, instruct her to do her job in a particular way. She was employed, existed an employer-employee relationship between them. Although when she was working exclusively with Yashraj, she was getting paid on a monthly basis, and Yashraj had complete control over her activities. That within the timings that she was working with Yashraj, and therefore there did exist a employer-employee relationship. Otherwise, when with multiple production houses, it would be an assignment-based employment, and assignment based, we're not taking into account that assignment based employments here. We are talking of an exclusive employment, right? Getting this, Ishan, are you getting the reason why the fourth case of Pariniti was not in the nature of salary? Okay, then Kavita, I don't think there is a problem with the mic. The mic is very close and there's no other complaint. I guess you should check your device. Krishna, how could you get the notes? You have to download the notes. I've already uploaded them. Oh, Krishna, you will have to be a little specific. कौन सा वाला eighth point? मुझे नहीं पता कौन सा eighth point आप बात कर रहे हो. Then, okay, Vaishali had a question. Provident fund में 12% of salary or 9.5% interest. Will it be taxable or not? No. Up to 12% of salary and 9.5% of interest, it is not going to be taxed unless and until it is an unrecognized provident fund. If at all it is a recognized provident fund or a statutory provident fund, 12% salary contribution made by the employer is not going to be taxed. 9.5% interest, not going to be taxed. Anything beyond that, only alone would be taxed. Her next question is whether it would be taxed on maturity or due basis. Well, it is deemed to be received. We have seen section 7, which says that it is deemed to be received. Right? And therefore, it would be taxed in the year in which the contribution is made. Now, well, Ishan, yes, if the actor is not an employee, then nothing would be taxed as salary. There's no thumb rule that an actor is always a professional. An actor could be an employee. Usually, the serial which you see on television, there, a particular actor could be an employee of a particular organization. Let's say Balaji Telefilms. They would employ, they'll keep it as they'll keep the actor as an employee. He would then be, taxable under the income, under this head, income under the head of salaries. Yes, you are right, Varsha. In the fourth case, Pariniti was working as a freelancer, and therefore everything she did was not taxable under this head. But it does not mean it would not be taxed under other head. It would still be, taxable under PGBP. Then, okay. So I guess I have answered queries. Let's move further. Taxability of allowance. Profit in lieu of salary is defined to include any payment due or received by an assessee from an employer or a former employer. So whatever payment that the employer is giving to an employee would be, salary or profit in lieu of salary by virtue of employment, obviously by virtue of employment. Now, therefore, sometimes what an employer does, apart from salary, in addition to salary, the employer also gives various allowances. And why would there be a need for allowance? The need for allowance is to compensate the employee, isn't it? Why I am giving my employee salary for the work he does. Then what is the need for giving allowance? If he does anything for me and for that act he would incur any expenditure, I would have to provide him allowance. Otherwise, why would he expend? And therefore, allowances are usually given to employees to meet particular requirement of the employment. Are you getting my point? There are requirements of employment. You'll have to come from the residence to the place of employment. From the place of employment, you'll have to go to the client location. As you enter your articleship, what would happen? You'll go to the office, and thereafter you'll go to the client location. Now you'll have to incur some expenditure from moving from office to the client location. In order to compensate that cost of going from office to the client location, your employer would usually give you some allowance. Now, that allowance is part of your salary income because any payment received from the employer. But then I need not give, I need not give any payment, and make it taxable. If at all there is a profit out of that payment, only then should I tax it. Do you all agree? It is profit in lieu of salary. What would be profit? Profit would be allowance minus the expenditure that I've already incurred. And therefore, I'll have to deduct the expenses that I've incurred. So allowances would be taxable. However, if I incur actual expenditure, it would be deducted, provided though that allowance is given for official discharge of my duties. If it is for personal expenses, then it is going to be taxable. If it is for official purposes and I actually incur expenditure, then it is going to be exempt. Let us see how it goes. So either an allowance would be fully exempt or an allowance would be fully taxable. There is a midway as well. So certain allowances are partly taxable and partly exempt. Right. First, let's discuss fully exempt allowance. So fully exempt, what is fully exempt? Any allowance given to High Court and Supreme Court judges or officials of the United Nations. These are fully exempt entirely. Now, why would they be exempt? Well, exemptions are given usually to employees who are in power position. So United Nations officials, power position, Supreme Court judges, power position. So compensatory allowance or sumptuary allowance given to High Court and Supreme Court judges specifically said, you have to exempt those. Sumptuary allowance, there would be, one question I'm sure. And what is sumptuary allowance? Sumptuary allowance are usually granted to compensate, expenditure incurred on entertaining visitors. Employees in power position, like the judges or the member of parliament, they usually have got a lot of visitors. And when you have got a lot of visitors, what you have, similarly, compensatory allowances could be given, which take care of the cost of living. Or on the contrary, if a particular judge is located at a remote location, well, he would not have to incur a lot of cost. So whatever is the compensatory allowance or allowance given for high cost of living, that is again exempt. So these are fully exempt allowances. But most of the employees are not going to get benefit of the fully exempt allowance. What is fully taxed? Well, every other employee is going to be taxed. So entertainment allowance, dearness allowance, taxable. Overtime allowance, taxable. Fixed medical allowance, taxable. Everything else is taxable. Entertainment allowance in case of government employee is deductible. Sorry, it is not exempt. It is deductible under section 6, item 2, to the extent of 5,000 or 1/5 of the salary. Right? To the extent of 5,000 per annum. So that is the amount of deduction a government employee could claim in case of entertainment allowance. But I'm not sure whether government employee actually get entertainment allowance. Then, so DNS allowance, overtime allowance, fixed medical, city compensatory. Usually, an employee who is posted, let's say in a small town, and thereafter he is asked to move to a bigger town, right? Bigger town would mean higher cost of living, and therefore to compensate that, city compensatory allowance is given. That is also taxable. Interim servant allowance, project allowance, etc., etc. So a lot of those, by whatever name called, it is going to be taxed. However, partial exemption is given on few counts. So you understand fully exempt and fully taxable. Let's move to the partially exempt. Understand, before I move on, if a particular allowance is given by the employer to the employee for official purposes only, if it is given for discharge of official function, like moving from the employer's location to the client location, and you actually expend that money, in that case, that exemption is that allowance is entirely exempt. Now, partially exempt allowance, one is house rent allowance, which is exempt under section 1013A. 1013A deals with house rent allowance, HRA. See what happens. A particular employee would be, let's say, he's located in Mumbai. He has got a permanent residential house in Mumbai. Now, an employer would ask him to move from Mumbai to Delhi. Now, when he moves from Mumbai to Delhi, what happens? The house that he had in Mumbai is no more available to him, and he'll have to go to Delhi and take a house on rent. Now, why is he paying that rent? He's paying that rent only because the employer wants that particular employee at a different location. Now, an employee would be reluctant. He would say, no, I don't wish to go to Delhi because I don't have a house there and I'll have to incur rent. And therefore the employer would say, okay, no, employee is okay with it. But the problem is this allowance, if it is made taxable in the hands of the employee, what happens is he loses the benefit. Basically he has agreed to move from Mumbai to Delhi only because the employer is willing to pay something extra. But if I if I deduct tax, in that case, I'll receive lesser amount, and therefore specific exemption is given. So special allowance to meet expenditure actually incurred towards rent. Now, what happens if I don't pay any rent? I'm an employee. I move from Mumbai to Delhi. Tell my employer that, boss, I'm not going to go to Delhi. You have to pay me HRA if you want me to go to Delhi. He says, okay, take HRA, you go to Delhi. I shift myself. However, I reside in one of my relatives' house, and I don't pay any. If at all, the rent is not paid, actual rent is not paid, then nothing is going to be exempt. Rent should be actually paid. Secondly, for residential accommodation occupied by the employee, so it should be paid for residential accommodation of the employee. If it is paid for any other person, that is again not eligible for exemption to the extent as may be prescribed. So 1013A says that whatever allowance is given to you for the purposes of expenditure that you actually incur for rent is exempt to the extent prescribed. Now, where do I go for prescription? I'll have to go to Rule 2A. Rule 2A prescribes the amount of exemption. Now, what could be the amount of exemption? Understand this. One is the actual amount of HRA received. Maximum, what could be exempt? Whatever you have received, not more than that. Getting my point? Maximum, what would be exempt is only the amount of allowance that is received. Secondly, actual rent in excess of 1/10 of salary due for the relevant period. Right now, look at this. This second condition is fairly logical. My employer pays me HRA, and I pay rent. They say that to the extent of 1/10 of your salary, you are anyways responsible, right, to pay the rent, or wherever you live, you are, you would have incurred some cost towards that residence, either the upkeep of that residence, and therefore they say actual rent paid minus 1/10 of salary. This is very logical. Less 1/10 of salary, whatever you pay in excess of 1/10 of salary alone could be claimed as exemption. Then 50% of salary due if the house is in Mumbai, Chennai, Kolkata, or Delhi, 4 metros. So, and in any other place, 40% of the salary. So maximum deduction could be the amount of actual HRA received, rent paid in excess of 10% of the salary, or 50% of the salary if the residential house is located in 4 metros, 40% of salary if the residential house is located in any other place. So that is the amount of exemption. We take it by way of an example, you'll understand it better, but then it is the least of the three. When you look at the point C, you would notice that it is 50% for metro and 40% for other places. The reason is again simple. Metros have a higher cost of living, higher amount of rent got to be paid, and therefore 50%. For other places, it is 40%. Why 50 and why 40? There is no, I cannot justify that. However, 50 and 40 looks logical. 40 is 10% less. The reason is because with other towns, the cost of living is a little on a lower side. Then, relevant period. See, when it comes down to point B here, it is rent paid in excess of 1/10 of salary for the relevant period. We are talking of the relevant period. What is this relevant period? See, I was in Mumbai until 1st of, let's say, July 2022. Now I take a new house on rent only from, let's say, 1st of August 2022. Right. So if I'm taking it in the month of August, my relevant period would start from August until March. So long as I've taken a house on rent, only then would there be an exemption. Right. So relevant period means period during which accommodation is occupied by the employee. So if at all an accommodation is not taken or not occupied, there is no question of giving any exemption. Moving further, what do you understand by the term salary? What is salary for the purposes of 1013A? They say salary includes DA if provided in terms of employment, but exclude all other allowances and perquisites. So simple, salary means salary plus DA. However, there was a landmark ruling in case of Gestetner duplicators, wherein what happened was this company had 3 kinds of salesmen: machine salesman, mixed salesman, supply salesman. Now what they did give fixed salary to all kinds of salesmen. But in addition to the fixed monthly salary, they were also paying salary as a percentage of turnover achieved by these salesmen as an incentive. So the salesman who does more of the turnover gets more of the salary. That was the entire intention. Now the commission was sought to be taxed under the head of income from other sources by the officer. The matter went before the Supreme Court, and Supreme Court said that salary includes commission, provided the commission is paid, as a fixed percentage of the turnover. So whenever because it was a Supreme Court decision. Now it is a law of the land. So if you talk of the fourth schedule specifically, which deals with provident funds, this fourth schedule deals with provident fund. Here the definition of salary is salary plus DA. But because of gestational duplicators, now the definition of salary for the purposes of Income Tax Act is, for all the provisions of the Income Tax Act by default is salary plus DA plus commission based on a fixed percentage of turnover. Only if the commission is based on fixed percentage of turnover would it be included in the definition of salary. So this I call as default definition. This is the default definition. Salary means salary plus DA plus commission as a fixed percentage of turnover. However, what happens is why do we have so many different definition of salary? Some of you would have gone through the Income Tax Act by now, and they already know that there are different definitions of salary. Why we have those all definitions? Because some of the items like gratuity for that matter is governed by the Payment of Gratuities Act. And in that Payment of Gratuities Act, the definition of salary is different. And therefore, we need to understand, each of the provision, and in that every provision will have a different definition of salary. But most of the times you will have this default definition. HRA is not governed by any other statutory act. It is governed only by Income Tax Act. Since it is governed only by Income Tax Act, you have got a standard definition of salary or the default definition, which is salary plus DA plus fixed commission based on fixed percentage of turnover. Then no exemption would be given if the accommodation is owned by the employee. I have got an accommodation in Mumbai. I also have an accommodation in Delhi. Now I am not paying any rent, and therefore, if it is owned by me, there is no question of payment of rent, and therefore there is no question of exemption under 1013A. If the assessee does not incur any expenditure, he's staying with a relative or a friend, again, you don't have any exemption. Similarly, if the expenditure does not exceed 10% of salary, the idea is at least 10% of the salary should be borne by the employee. So if at all anything in excess of 10% of the salary is incurred by the employee, should he get the benefit? Let's take it by way of an example here. Ishan is employed with RIL with a monthly salary of 60,000. DA is 20% of basic. 70% would form part of the retirement benefit. He receives HRA of rupees 30,000. He receives an increment of 10,000 in the basic salary from 1/1/2023. Arrears received during the year is 80,000. He takes house on rent from 1st of November 22. Compute exemption under section 1013A. See, just go through the problem. Sorry. Just go through the problem. Yes, gestational duplicator is a Supreme Court ruling, because of which we see that commission which is paid as a fixed percentage of turnover is part of the salary. See if you could solve this. Let me also show you the rule. Sorry. See, first and the foremost. Okay, option D, I've got a few answers. Well, Darshan, HRA is monthly because I've given monthly salary. Even the HRA is monthly. Else I would have written per annum. Okay, I've got a few answers. See, understand. HRA is received on a month-on-month basis usually. So, like in this case, Ishan is getting 30,000 rupees of HRA per month. So, in other words, he's got 3,60,000 rupees of HRA. However, my house had been taken on rent only from 1st of November 22. So, my relevant period for the purposes of exemption could only be from 1st of November 22. So November, December, January, February, and March, 5 months. That is what I'm concerned with, right? If I were to find out the exemption, I'm concerned with only these 5 months. During these 5 months, I have received an HRA of 1,50,000. Do you all agree with me? See, if HRA is 30,000 rupees per month, 1,50,000 is the HRA that I have actually received. So maximum exemption cannot exceed 1,50,000, right? Now, however, what is the amount that I've paid as rent? So I've paid 25,000 rupees, isn't it? 25,000 rupees. So for 5 months, I am paying 25,000 into 5, that is 1,25,000. So now immediately what happens? 1,50,000 exceeds 1,25,000. So I know that 1,50,000 entirely is not exempt. But this 1,25,000 rupees again is not entirely exempt because I got to deduct 10% of salary out of this 10% of salary. The reason is I should bear at least 10% of the cost, of the salary. To the extent of 10% of salary should be my cost. And therefore, the rent actually paid less 10% of salary, or rent paid in excess of 10% of my salary. That is going to be exempt. Now, what is my salary becomes important, therefore, right? Now, how much salary have I received during this period? I have received salary to the extent of, there has been a hike also in my salary from 1/1/2023. There's an increment of 60,000. So for the month of November and December, that is 2 months, I've got a salary of 60,000 per month, basic, multiplied by 2, and 70,000 rupees per month for next 3 months. So the 5 months breakup is like this: 60,000 rupees per month, for 2 months, November and December, and 70,000 per month, 10,000 rupees of increment for this January, February, March. Well, further they say that DA is 20% of basic. I have got a DA of 20% of the basic salary. So whatever salary I receive, 20% of it, an additional dearness allowance is something that I would receive. So these two taken together, 1,20,000 and 2,10,000 is 3,30,000. 20% of this is going to be my dearness allowance. But out of that dearness allowance, only 70% is going to form part of my retirement benefit, or is provided out of the terms of the employment, and therefore only DA that forms part of the salary for the purposes of computing retirement benefit or provided in terms of employment would be included. And therefore I add to this, 20% of 3,30,000 multiplied by 70%. Multiplied by 70%. So it should be 46,200. See, look at this. 20% would be 66,000. 3,30,000 multiplied by 20% is 66,000 multiplied by 70%. That is 46,200. So my total salary is 3,76,200. 10% of this, 10% of this would be 37,600. So I pay actual rent of 1,25,000 less 37,600. This is going to be my maximum exemption. So my maximum exemption would be 87,400, 380. Sorry, 620. 87,380 rupees. This is going to be my maximum exemption. If the HRA that I received for 5 months was 1,50,000 and my exemption is 87,380, the rest of the amount would become taxable. However, HRA would be received for the entire year. See, here nothing is said, nothing is stated. If at all the HRA is received only for 5 months, then 1,50,000. Else, for the entire year, 30,000 into 12. So that would be my HRA that I have received. Less 87,380. Oh, made an error. Let me just add one more information to the question. The question was made by me and I made an error by framing the question. He receives HRA of rupees 30,000 with effect from 1/11/2022. So that's the only extra information that I'm giving you. So my actual HRA is going to be 1,50,000. Okay, so that would become my taxable HRA. So 1,50,000 minus 87,380 would become my taxable HRA. However, I am supposed to calculate only the amount of exemption here. My exemption is going to be A, option A, 87,380, because 40% of salary. Now, what is 40% of salary? That is 3,76,000 multiplied by 40%. That would be again higher. So 3,76,000. Let's check it out. 3,76,200 multiplied by 0.4. That is 1,50,480. Actual HRA received 1,50,000. Rent paid in excess of 10% of salary, 87,380, and 40% of salary would be 1,50,480, whichever is lower. So what is lower? 87,380, which is nothing but my exemption under section 1013A. So I guess you are getting the answer. Balance would be taxable. Balance amount would become taxable. So yes, Bhumika, you're right. The option is A. Are you getting it, friends? See, I'll just explain because I'm not getting too many answers. So I'll just briefly explain you again. I've got 3 limits. One is the factual limit. What is the actual amount of HRA received? Let's say the actual amount of HRA received is 1,50,000. Right? So that is my first limit, actual amount of HRA received. What is Rule 2A prescribing? Rule 2A prescribes that least of the 3 would become exempt. So actual HRA or the factual limit is 1,50,000. Rent paid. What is the rent paid during those 5 months? 1,25,000. During those 5 months, my salary was 3,30,000 plus the DA, right? I hope you are getting 3,76,000 rupees of salary. 3,76,200 is what I have received in terms of salary for those 5 months, right? Now 10% of this, 10% of this, which amounts to 37,620, is something to be borne by me, and therefore I deduct 37,620 out of the actual rent that I have paid, which comes down to 87,380. So this is my first limit, my second limit, and third is 40% of this amount, 36,000. 40% of 36,000, 3,76,200, which amounts to 1 lakh, sorry, how much? 1,50,480. So 480. Least of the three is 87,380, which is exempt. Well, let's move, therefore. Now I hope it's clear. We'll take up a few more problems on HRA. Don't worry again. Now, HRA, you won't get a problem on HRA independently. Usually it is by way of an adjustment that you'll get this, you'll have to work it out. Mostly. Now, special allowance for official duty, exempt under section 1014. Section 1014 deals with any special allowance that is given for discharging the official duties. We have already discussed this, but what 1014 has to say? Granted to meet prescribed expenditure exclusively incurred in performance of duties of the office. So that allowance, whichever is given to you, should be incurred for the purposes of official duty only and not for any other purpose. If you do it for any other purpose, or if you save some money, let's say you get an allowance of moving from the employer to the client location to the extent of 10,000 rupees, and you expend only 5,000 rupees out of it. The remaining 5,000 rupees is going to be taxable as your profit because you have not actually incurred that expenditure to the extent such expenditure is actually incurred. What are these allowances? Traveling or transfer allowance. Usually an employee is required to travel from one place to another for official duty, or is transferred from one place to another. In our earlier case, the employee was transferred from Mumbai to Delhi. Now he would have to carry his belongings to Delhi, and therefore he'll also have to, incur some amount of expenditure for the purposes of that, transportation of the belongings. If at all the employer compensates, if at all the employer compensates the employee for such transfer, well, in that case, it is going to be exempt if the employee actually incurs expenditure. Similarly, daily allowance to meet ordinary daily charges while on tour or journey. Most of the times you would see that sales personnel, they are on a tour always, away from their house. Now they require, food to be taken outside their normal place of residence. They would require a hotel, in some other place where they are touring. So these expenses are taken care of by employee by way of a daily allowance. Usually in northern part of the country, we call it as bhatta, right? This amount is given as a daily charge to take care of the charges which are required ordinarily for an employee to stay at another place. So if at all you actually incur the expenditure out of the daily allowance, you are going to be exempted in respect of that allowance. Similarly, conveyance allowance, conveyance for performance of duties of office is again exempt. Helper allowance. Now, this is one important allowance which is used by a lot of employees who are in good positions. Senior employees who cannot work too much, they would have a personal assistant, PA is what we call it. And that personal assistant would be taken care of or paid by the employee, by that senior employee. Now the employer, what he does is he reimburses the cost that is paid to the PA to the employee. So we've got three persons here. One is the employer, right? Two, you have got the employee. And three is an employee of the employee or the helper of the employee. Now this person, this PA is employed by the employee. The employer, the original employer, is going to reimburse this employee for the cost, for the salary or the cost that he has incurred for employing the PA, right? Now, let's say the employer pays to the employee 50,000 rupees for the helper, and the employee in turn pays to the helper 30,000 rupees. 20,000 rupees have not been actually incurred. So 20,000 rupees is going to be taxable as salary in the hands of this employee. If this employee actually incurs entire 50,000, then nothing is going to be taxed. If he incurs 60,000 rupees, you are not going to get any deduction for the additional 10,000 rupees of expenditure, because deduction is governed by section 16, and section 16 do not allow any deduction unless and until specifically it is covered. So this 10,000 rupees, you are not going to get any deduction. Do you get it? The helper allowance, expenses of helper engaged for official duty. Sometimes, in case of senior employees, they do get personal assistants. Now, these personal assistants are not directly employee of the employer. So helpers, well, or let's say a car driver usually is employed by the employee. He could be a helper. Now, that is exempt to the extent incurred. Going further, research allowance for encouraging academic research. If at all an employer is paying to the employee any research allowance and the employee actually does the research, incurs the cost, well, that is again exempt. Uniform allowance for the purposes of purchase and maintenance of uniform. Understand, uniform allowance would be given to an employee to purchase the uniform. If the uniform is not purchased, there is no question of claiming any exemption. This uniform is only because the employee is taking up employment, and therefore should be exempted if any cost is incurred, right? So these are the items of special allowances which are exempt to the extent expenditure is actually incurred. If there is no actual expenditure incurred by the employee, nothing would be exempted. Let's move further. Now, what we have dealt with is allowances for official purposes, research for official purposes, conveyance client location to the office or office to the client location, again official purposes. But sometimes what happens is you also have some personal expenditure, and in order to take care of the personal expenditure, allowances could be given. Like house rent was a personal expenditure, right? Paying rent or staying in a particular house is a personal expenditure. So it is separately covered under section 1013A. Here we also have some more of such items wherein personal expenses at the place of duty or at the place of residence, allowances are given by the employer and it is partially exempt. Well, before I move on to Rule 2BB2, wherein personal allowances are partially exempt, I'll just take up a few queries. Okay, helper allowance, Darshan, is simple. If at all a particular employee has employed a helper and the employer reimburses the cost of that helper, and the amount is expended by the employee, it would be exempted provided the helper is for the official duty. If is for residential duty, the helper, making the lawn of the residence. Now that gardener, though is a helper, is not for official duty and therefore would be taxable. Helper for official duty exempted. Conveyance allowance, Rama, conveyance allowance from home to office. Home to office is the responsibility of the employee. Nothing is exempt. Office to client location. Client office. That alone is exempt. Home to office is exempt only in case of one category of employee, and that is those who are physically handicapped. Those who are physically handicapped, they need some more expenditure, right? To move from home to the place of work. And therefore, 30 to 100 rupees per month is the maximum exemption that you could claim under this Rule 2BB that I am talking of. Though it is a personal expenditure, yet it is exempt to the extent of 3,200. But in case of no other employee, see, allowances exempt regardless of actual expenditure. It is personal expenditure for which this, allowances are granted, and therefore whether you incur those expenditure, whether you spend money, whether you actually pay for it or not, is totally irrelevant. Most of them are exempt. Most of them are taxable. Only a few of them, looking at the propensity of the allowance or the reason why the allowance is given, it is exempted. See, we'll just go through those exemption and we'll understand at once. Any special compensatory allowance in the nature of hilly area or high altitude, uncongenial climate, or snowbound or avalanche allowance. Look at this, the risk the employee is facing here just because he is posted in a hilly area, a high altitude, uncongenial climate. There is enormous risk and there is enormous cost of staying in such area because you don't have too many resources. If at all you are given allowance to the extent of 300 rupees per month when the altitude is 1,000 feet, 9,000 feet and above, 800 rupees per month. And if at all a particular person is located in Siachen area of Jammu and Kashmir, it is extremely rough weather in Siachen. There you have 7,000 rupees per month of allowance, which is exempt. Now, 7,000 rupees per month is not big enough when you talk of Siachen. It is the most ruthless weather condition that you've got there. So if a particular employee who's posted in Siachen, he gets an allowance of 10,000 rupees, right? Avalanche allowance of 10,000 rupees. What is exempt? 7,000 rupees. Balance 3,000 rupees would be taxable. Getting my point, friends? Yes. Moving further. Any special compensatory allowance in the nature of border area, remote locality. So remotely, sometimes postings are done at a very remote location. Let's say Andaman Nicobar, very remote, difficult area, disturbed area. In that case, these allowances are subjected to partial exemption. So if a particular employee is located at Andamans or Himachal, Lakshadweep, 1,300 rupees per month, right? Continental shelf for the EEZ, exclusive economic zone, that is up to 200 nautical miles, right? If a employee is posted at high seas, well, 1,100 rupees per month. So you have got different limits. You will have to go through them, partially exempt. See, remembering these, one point would be, how do I remember these partial exemption? Well, you don't expect, a very difficult point to be covered while this particular exemption would be asked in the exam. You would have to just go through it, try and understand them logically. You already understand. See, Siachen more dangerous and therefore 7,000 rupees per month. When it comes down to Arunachal, Sikkim, Manipur, they are at an altitude of 9,000 feet and therefore 800 rupees per month. When you look at the special compensatory allowance also, you'll find that, it is all based on the risk of the posting of the employee. And therefore, just try and read it, try and retain as much as you could. Not necessary that you should, take any pressure of remembering all of it, but the important ones, those which that yes, it could possibly come in the exam, the general ones. So like children education allowance. This is a general allowance. It could be granted to anybody, right? Any employee. So it's a general allowance. Now, this general allowance would come by way of it could appear in exam because it is applicable to each of the employee. So 100 rupees per month to the maximum of 2 child. Are you getting my point? 100 rupees per month to the extent of 2 children is exempt. So if at all a person is getting 200 rupees per month for 1 child, and he has 1 child indeed, so 200 rupees out of 200 rupees, 100 rupees would be exempted, 100 rupees would be taxable, right? If he has got 2 children and he has got 100 rupees per child, in that case entire amount would be exempted. So children education allowance, similarly children hostel expenditure allowance to the extent of 300 rupees per month is going to be exempted. Employee of transport system. See this. Item 4. When there is an employee, let's say he an employee of railways. Now railways, he'll have to move from one place to another every day, day in day out. He'll have to move from one place to another. Now when he is out of his residential area, he'll have to expend some amount for the purposes of having dinner or lunch. Wherever he gets down, he'll have to take some rest. Now, if there are no facilities at that particular station, he'll have to go outside and expend on his own. What could happen? There could be an allowance which could be given to such employee to meet these personal expenditures. 70% of the allowance or maximum 10,000 rupees per month is the amount of exemption that it could claim if at all the assessee is a transport employee. Are you getting it, friends? So 14,286 would be the break even. 14,286 would be the break even. 70% of this amount is 10,000 rupees, right? So if an assessee is getting 10,000 rupees as allowance, he would get an exemption of only 7,000 rupees, 70%, right? Maximum exemption that you could claim is 10,000 rupees. So if a particular employee is getting 20,000 rupees, he's into transport system, railways or airlines, and he's getting 20,000 rupees. In that case, 70% of this would be 14,000. However, the exemption would be restricted to 10,000. So maximum exemption 10,000. This particular allowance is exempt only if the employee is not in receipt of daily allowance, the bhatta that I was talking of. If the employee is already in receipt of daily allowance, see, look here, we have already considered daily allowance. If he receives daily allowance, then there is no question of again giving an exemption here to an employee of transport system. Then, so I hope you get the education allowance and the hostel expenditure allowance available subject to a maximum of 2 children, right? Not more than 2 children. There is one question that a lot of students ask. What if the second child is a twin? Well, here there is no such relaxation like you have here, maximum 2 children. Then compensatory field area allowance, 2,600 per month. Counter-insurgency, see, look here, counter-insurgency. Now, this is for the armed forces. When there is insurgence or when there is, terrorist activity and the employee is asked or the member of the armed force is working away from the location, 3,900 per month is the amount of exempt allowance which a person could have. Then transport allowance to blind, deaf, dumb, handicapped person, 3,200 rupees per month is the maximum exemption. This is for commutation from the place of residence to the place of office. It is available only to handicapped individual and not to anybody else. Until financial year 18-19, we had this exemption for all the assessees. So 1600 rupees was the limit until financial year 18-19. But post that, we had something called a standard deduction. There's one deduction that we are going to see, section 16IA, which deals with standard deduction. When standard deduction was introduced, this transport allowance in case of all other employees was removed. However, for handicapped and blind, deaf and dumb people, 3,200 rupees as a measure of care to, extra expenses, which is required for the specially abled, you have to give them that allowance. Then you have got underground allowance of 800 rupees per month. People usually working in the mines, extreme weather, they would get the underground allowance. Further, high altitude allowance to the armed forces, members of the armed forces. Similarly, island duty allowance or special compensatory highly active field area. Some part of the country, thanks to our lovely neighbors, they are highly active. There is always some activity going on the Pakistan border, the Chinese border. Now we've got a highly active field in Manipur as well. So whenever special compensatory allowance is given to a member of armed force for working in a highly active field, 4,200 rupees per month is the amount of exemption that you could claim in respect of this allowance. So if at all a person is getting 5,000 rupees, 800 alone would be taxable. Similarly, island duty allowance is 3,250 rupees. So if a particular person is posted in Andaman and Nicobar or the Lakshadweep, he could claim 3,250 as exempt, if at all he is in receipt of the allowance. If there is no allowance, there is no exemption. Now, when a particular assessee opts for section 115 BAC, that is the alternative tax regime, meaning what? You've got an alternate tax regime wherein all the exemptions are taken away. In that case, you do not get exemptions under 1014 of this, if at all the employee opts for new tax regime, except for the transport allowance. This is the only thing available. Even if the employee opts for new tax regime, yet this particular allowance would be available as exempt to the extent of 3,200. Rest of it would not be available. Next year on, friends, the new tax regime, see, for your examination purposes, it is the old tax regime which is important. But next year on, new tax regime is made the default tax regime. So if at all a person wants to opt for old tax, then only he has to fill a form. Otherwise, he would be covered by the new tax regime. And it would see a lot of changes, as far as the computation aspect is concerned. But for the time being, you don't have to worry about it. When you come into the finals, well, you'll see a changed picture. I'm sure about it. Now, moving further. Do you get it, friends? Everybody, the allowances. Let's take up a small problem so that, you will understand it in detail. And we end our day after this problem. Okay, we'll start with gratuity the day after. Okay. Let's take a small problem. Yes, Harnoot, these allowances, the list of allowances is available in the module as well, study material as well. You could just go through them. Okay. See, look at this. Sudhanshu, an Air Force pilot. Okay, just go through this question. Sudhanshu, an Air Force pilot, gets a grade pay. So we are dealing with one more concept here. He gets a grade pay. gets a grade pay of rupees 50,000. Sorry. Have you worked with grade pays? Look at this grade pay of 50,000, 5,000, 75,000, 10,000, 1,25,000 per month. So Sudhanshu is an Air Force pilot and he gets, salary to the extent of 50,000, 5,000, 75,000, 10,000 and 1,25,000 per month. He has joined on 1st of June 2013. So this is really interesting. I am told that he has joined on 1st of June 2013. I need to find out his salary during the year 2023, 22-23. Now, what is going to be his salary for during the financial year 2022-23? Can you tell me what would be the scale of his salary? Anybody? See, interesting. How much salary did he get during the period of April 22 to March 23? Just tell me the amount with logic, with the calculation. She has been employed on 1st of June 2013 is the information that I have got. Darshan says it's 1,25,000 per month. Well, Darshan, you need to reconsider your working. The grade pay system. For those who are not aware of it, I'll explain in a short while. But for the timing, just have a look at it. Okay, no. I guess I don't have answers for this. Let me show you how it works. See, mostly in organized employment, you have got a grade pay system. How it works? Sudhanshu was employed on 1st of June 2013. On 1st of June 2013, he was employed for 50,000 rupees per month. Now, at the time of employment itself, both the employer and that 5,000 rupees hike every year, after every year. So on 1st June 2013, his salary was 50,000. On 1st June 2016, 2014, his salary would become 55,000. There would be a hike of 5,000 rupees. And this 5,000 rupees hike would continue until his salary becomes 75,000. 75,000. Getting my point? So 50,000, 5,000 rupees of hike until the salary is 75,000. Now the difference between 50,000 and 75,000 is 25,000. So how much time would it require to reach 75,000 rupees of monthly pay? Well, he'll require 5 years, isn't it? So for the financial year until, 2016-17. Look at this. On 1/6/2016, 13, 14, 15, 16, 17. Sorry. His salary would be 75,000. Thereafter, every year his salary would increase by 10,000. So on 1/6/2018, his salary would be 85,000. Are you getting this, friends? On 1/6/2018, there would be a hike of 10,000 because the grade pay has increased from after 75,000, 10,000 rupees of increment every year until 1,25,000. So it is not going to increase beyond 1,25,000. 1,25,000 would be the end of it. So 1/6/2018, it would be like 85,000. 2019, it would be 95,000. 2020, it would be 1,05,000. To 2021, it would be 1,15,000. And 2022. So see, until from 1st June 2021 to 1st June 2022, his salary would be 1,15,000, and post that it would be 1,25,000. See, do you get the concept of grade pays? Look at this, friends. Do you get it? The grade pays. Okay, yes, Harnoor, you're right, absolutely right. I made an error here. It should be 1/6/2018, that the amount should be 75,000. So we got to go one step back, I guess. So here it would be 1,15,000, and here it would be 1,05,000. Yes, sorry. Okay. So for 2021, it is 1,05,000. Yes, Arnold, thank you for just bringing it to my notice. For 1st June 2021, it would be 1,05,000, and for 1st June 2022, it would be 1,15,000. With this, let's move further. Very good. Now, apart from the grade pay, the basic, he is also in receipt of dearness allowance of rupees 12,000 per month. And 40% of that 12,000 is the part of retirement benefit. He has received helper allowance of rupees 10,000. Look at this, helper allowance of 10,000 rupees. Now, this is going to be taxable to the extent it is not spent. Uniform allowance, 2,000 rupees per month, taxable to the extent not spent. There is an active field area allowance. This is something that we have dealt with. Look at this here, active field area allowance for a person of armed forces. He's an Air Force pilot. 4,200 is the amount of exemption. What is the amount that he has received? 5,000. So 800 is going to be taxable. You've got counter-insurgency allowance of rupees 4,000, right? So counter-insurgency allowance as it stands, exempt up to rupees 3,900. How much has he got? He has got 4,000. So 100 rupees would be taxable. Then children education allowance of rupees 500. per child 250. It means he's got it for two children, right? 250 rupees for two children, 500 rupees for both of them. However, we have got an exemption only to the extent of 100 per month per child. He has got 500 rupees per month per child. Then children hostel allowance. Hostel allowance is got only for one child and not for two, right? So he doesn't get an exemption of 600 rupees here. He'll get an exemption of only 300 rupees. So out of the 1000 that he has received, he would get an exemption of 300 rupees per month per child. Since he has got it only for one child, we claim exemption to the extent of 300 only. Had he got it for two children, 1000 rupees for two children, in that case, 600 rupees would have been the exemption. And thereafter, I've got HRA for Chennai residents, Chennai residents. This is why we have to calculate the grade pay and the dearness allowance. Had it not been this HRA related adjustment, we would not have calculated the amount of salary, because salary, 10% of salary is what we have to calculate here, right? But otherwise, for all other allowances, we don't have to calculate salary. Allowance at 2 and 3 have been actually expended by him to the extent of 80%. Helper allowance, out of 10,000 that he has received, 8,000 rupees have been expended. 2,000 rupees per month, that is 24,000 rupees per annum, would be my taxable helper allowance. Similarly, uniform allowance, 1,600 rupees have been expended. So 400 rupees would be taxable per month. Also, he has paid 50,000 rupees as rent. So Chennai residents, he's got a HRA of 50,000 and he has also expended 50,000. So ideally, whatever he has received, he has paid, but then yet some part of it would be taxable, because 10% of salary is something that was his responsibility, right? So only rent paid in excess of 10% would be exempt, right? I'll just briefly show you the solution. Just go through the solution once. It is very, very simple. Just go through the solution. See here, basic pay. Well, it goes like this: 50, 55,000, 60,000, 65,000, 70, and 21, 22, you've got 1,05,000. 22, 23, that is from 1st June 22, the pay would be 1,15,000. So for the first 2 months, that is for the month of April and May, my pay is how much? 1,05,000. Post June, post May, from June onwards, I get a salary of 1,15,000. So my total salary would be, look at this, 1,05,000 multiplied by 2 months plus 1,50,000 multiplied by 10 months. The total salary is going to be 13,60,000. Add to that dearness allowance. Dearness allowance is 12,000 rupees per month. For 12 months, I get 1,44,000. See here, dearness allowance is 12,000 rupees per month. 40% of dearness allowance alone forms part of the retirement benefit. You have to consider this 40% alone while calculating exemption under section 1013A, right? As far as helper allowance is concerned, look at this, 24,000 taxable. We have already discussed it. 120 is received, 96 is expended, balance 24 is taxable. Similarly, uniform allowance, 20% is taxable. Active field area allowance, he has received 5,000 rupees per month. What is exempt? 4,200 rupees per month. So balance 9,600 taxable. Counter insurgency, well, counter insurgency is exempt to the tune of 3,900. Just a second. Hope it's visible. Counter insurgency is exempt to the extent of 3,900 per month. What he has received is 4,000 rupees per month. So 1,200 rupees taxable. Children education allowance, 100 rupees per child. He has got 2 children and allowance is also paid for 2 children, right? 500 rupees is what he got. 200 rupees is exempt, 300 rupees multiplied by 12, 3,600 taxable. Similarly, children hostel allowance to the extent of 300 rupees per child, exempt. What is got is 12,000 rupees for one child. For one child, the exemption cannot exceed 3,600. So balance is taxable. Now, as it comes for HRA, HRA is actual allowance 50,000 into 12, actual rent paid again 50,000 into 12, less the amount of salary, 10% of salary. So salary is something we have already computed, and 50%. See, 50%. The third condition is 50% of salary. Why 50% of salary? Because the location is Chennai. The four metros, 50%, rest of the country, 40%. But anyways, 50% of salary is 7,08,000, which is more than the actual rent paid. It is also more than the actual allowance. And therefore, this is never the basis. It is the least of the three. So least of the three is rent paid in excess of 10% of salary, which is 4,58,240. You try and compute this 4,58,240. It's going to be your home exercise. I've already given you the amount of salary and the amount of DA. It is very simple to compute 10% of it, right? So my total salary would be 16,97,360, inclusive of all the allowances after considering the exemptions available. Right, friends? I hope you've got it. What we do tomorrow or the day after is we start with the retirement benefits. We start with gratuity the day after. I hope I've made myself very clear. Just for those who did not get some part of the lecture, you just go through the lecture again. Try and solve some more problems on grade pay system. There could be, grade pay system is something unique in a way, because if you make an error while calculating, the way I did, I made an error of 1 year. So you have to be thorough while you compute the grade pay for the current year, right? Thank you so much, friends. I hope you have enjoyed the lecture. Let's meet on the 16th. If you have got any query, just put it into the question box and I'll be glad to answer those. But for the time being, let me just shut it down.